Thank you very much. I really appreciate the opportunity to have you all here together. And by the way, Pat, that was a fantastic kind of overview of the year here. So I'm super excited to talk about this topic and more excited to talk about it with Gary. We had a prep session about this, and there is so much to go over, so I'm going to jump into it right away. I'll start with maybe a couple of questions for you, Gary. Maybe the first one is, maybe give a little bit of your bio to give perspective to the audience, and then we will jump into a question about culture as it relates to IPO readiness.
Sure. So I'm Chief Financial Officer for Cleanspark. We're one of the world's largest publicly traded Bitcoin miners. We're traded on NASDAQ. We're about a $4 billion market cap right now. First half of my career, I worked in public accounting, mainly for large national firms such as McGladrey, which isn't around anymore, it's now RSM, and BDO. And then this last half of my career, I've worked with primarily high-growth publicly traded companies that are either publicly traded or pre-IPO.
Awesome, awesome. Thank you for that. So it was interesting when we did our prep session because you jumped into the question of culture as the first thing. Not what I expected. So I'm curious why, and then maybe talk about what do you mean by culture as it relates to IPO readiness?
Yeah, so I think when a lot of people think about IPO readiness, they think about getting a firm that's going to come and create a roadmap, or you get an IPO readiness guide. And also the technical things that you need to do to go IPO. But one of the things that I would put at the top of the list absolutely is culture, and it's a tone at the top. And what I mean by that is you're going to have a fundamental shift in how your company thinks and how you and your team thinks, not just during the IPO process, but to maintain just the compliance of being public. For example, I'm sure everyone has had that kind of push-pull relationship with either team members in sales or operations, right? And they're always going 100 miles an hour trying to close business and drive revenue, which they should do. And they don't want to get bogged down with paperwork or controls or policies and procedures sometimes. And then the accounting team comes in and says, well, we need this approval, we need this checked off, we need this type of form filled out. And there's sometimes a clash, right? And I think that relationship with other departments is always going to be there. But what's important, particularly in the IPO process, is to set the tone. And sometimes that tone needs to be set at the C-level, or more importantly, it needs to be set with senior management in the various departments to make sure that everyone's on board, to make sure that they do what they need to do with regards to compliance for being publicly traded, particularly around financial reporting. And this is important because you don't want to be in a position to where you have a control environment and there's certain individuals that just aren't taking it seriously, and you get hit with something as an auditor, right? Just because we're in accounting and finance doesn't mean that we're going to have eyes on every single transaction that comes through, or making sure that the approval of the workflow is followed to a T. That's why you rely on certain type of systems to be able to have that type of reliance. But if you have that culture where everyone understands that you need to be able to comply with the policies and procedures, it's ultimately there for a reason, and it's really to safeguard everyone and the company.
Amazing, amazing. The second area you alluded to controls. Control environment, process, those are words that get thrown around. I hear SOX, 404, all of that. How does that play into the IPO readiness journey?
Yeah, so it's, as a CFO, that's a big part of my job, right? Like it's probably the biggest pain in the butt. And Pat had said, oh, the fun things about being an SEC company. I'm like, okay, let me try and name a few fun things, right? Like I always joke when I first got into working with public companies, like I had a full head of hair, right? And it seems like I've especially lost even more hair working in the digital asset space, particularly with the SEC. But that's a topic for another time. As a private company, you just have a different focus of controls. I mean, all companies have controls, right? You have some segregation of duties with the prepare and review function, right? You'll have someone that's, signer on the account, but they may not be, processing bills or whatnot. But Sarbanes-Oxley takes it to a complete different level. And for those older people that have been around, or more mature professionals, I should say, you remember SOX came out, in the early 2000s because a result of some unscrupulous types at Enron or WorldCom, right? And that came out Sarbanes-Oxley, and now we have 404A and 404B, and it's very important to understand what that is now, because when you go out and get an audit firm that is going to do a PCAOB audit, which is different than the private company audits that you're used to, because there's different sampling methodologies and different scopes to comply with PCAOB standards. You definitely need to have a very robust internal control structure. And 404A is the requirement under Sarbanes-Oxley where management needs to opine on the operating design and effectiveness of your internal controls. So that's different than what we have in private companies. And so that means that management's going to need to make sure that you cover all the assertions and you have all your bases covered, and that the controls are documented properly, right? Because a big thing under SOX is not just signing off saying, yeah, I reviewed this. You actually have the evidence of the review. And it really depends on the judgment of the auditors, and it's crazy on how it can vary between the different firms, particularly if they're national firms, on what you have to document. Because, and those of you that have worked in public accounting, especially recently, you probably know that not only do you have to document what you did or how you did it, but sometimes you have to document why you didn't do something or what you didn't do. And so that documentation is also part of the culture shift, which I just talked about. That's a mindset that particularly the accounting finance department is going to need to be in, and or compliance or legal, to make sure that we round out the controls. But again, it's something you really need to consider, because even though you may not expect to reach the threshold, either revenue or market cap, to qualify for 404B, which is what requires a company to have an audit firm actually opine, so it's an independent opinion on the design and operating effectiveness of your controls. Even though you won't need that, you don't think you'll need it for a while, you better plan for that, because it comes real quick, right? And my predecessor, for example, at Cleanspark got caught off guard with that, because the market cap just went through the roof all of a sudden. And the testing point is at Q2, and all of a sudden the company was scrambling and they ended up with some material weaknesses. So you don't want to be in that position, and frankly, for those of you that sign off on the financial statements, you'll sleep a whole lot better at night knowing that you have really good controls, because again, you can't have eyes on every transaction. And as you may know, if you're signing off on the financial statements as a public company, you have personal liability under the Sarbanes-Oxley rules as well.
Yeah, let me piggyback off of that and ask a question about timing. I know there's no, specific time, but do I start today? Do I start 18 months before I'm thinking about it? Do I start, the day before? How complex is from a process and controls perspective, and how should I think about it in terms of when I start? Yeah,
that's a good question. I think that if it's in your roadmap to go public, which you may not be the decision maker on that, right? If you're private equity owned, or your board, or maybe it's your owners or investment group is going to drive that decision, I'll tell you, the more ramp time and leadway time that you have, the better. I think, I've met with companies where they say, hey, we want to go IPO in the next 6 to 9 months, and I ask where they're at, and they're not even done with their first audit. I'm like, yeah, good luck, right? Because the timing of it, there's so much that needs to do, that you need to do to not only file, and it depends which way you're going to go public too, right? Reverse merger, S1 registration, which is a traditional method. But really, it's making sure you have a roadmap and understanding where C-level or the board or whoever's making the decision to go IPO understand when they want to at least be in a position to go public. Because you might say, hey, look, our target is 18 months from now, and you do everything you need to do for 18 months from now, but the market may not be there, right? The market may not be there, and then that means you have to refresh your financial statements, your registration statement, every quarter or so until the market is there and the investment bankers say go. But you want to be in a position to where you have everything lined up and you're not scrambling, because not only is it going to cost you a lot of money, but it could cost you missing an opportunity of time in the market, particularly if the IPO market's robust.
Yeah. Let me add this to that, which is, or a question to that, which is, can't I automate this away? So you're saying process? I should be able to put in systems, just automate it away, but how do you think about that, the technology angle of that?
Yeah, and automating this, I'll tell you, I'm going to be long gone by the time the IPO process is automated. But I will say this:
AI is coming.
It's coming, but I think we got a long ways to go, right? I would tell you that as CFO, I've always had the philosophy that I want to rely on systems as much as possible because it's scalable, right? I have worked for CFOs that don't want to invest in technology or systems, and they just rather throw FTEs at it and just manually do the spreadsheets and do what it is because it's quick and easy. But in the long run, when you're operating your business mainly off of spreadsheets, there's a higher risk for error, right? And it's just not efficient. So I would tell you that what you want to do is if you can take a process and utilize a system, you should do that. And you should make sure that it's set up to be scalable. One example is ERPs, right? We're a NetSuite shop. I'm a big fan of NetSuite. And it's important to make sure that when you're implementing an ERP such as NetSuite, that you set it up to not just do and have the same functionality you have on maybe your old ERP, but also set it up to do what you want to do and where you think the 5-year growth plan is, because you're going to have a 5-year forecast. Someone in finance or the investment banker is going to have a forecast. And you're going to know where you're going. You got to make sure that it's scalable. And so using systems is extremely important. So I would start there first, and then once AI is proven and you can get the controls around AI and auditors become more comfortable with you running through processes through AI, then maybe. But for right now, I think it's just a classic traditional, have solid systems, have a good plan when you're implementing systems, which I'm a fan of. 30% of your budget should be in the planning phase. Like, you don't want to be planning while you're actually doing it, because it costs more time and money. But I think you just look at those robust systems.
Yeah, maybe talk a little bit. I know one of the aspects of SOX is IT general controls. Maybe just give a little bit of an overview or talk a little bit about that and how that influences the whole SOX journey.
So especially in digital assets, ITGCs, as they call it, information technology general controls, are very important. Now, historically, in my experience, I think that if you were primarily relying on out-of-the-box systems such as a NetSuite or Bill.com or whatever, and there's a SOC 1 Type 2 report that you can rely on, and it's relatively a non-complex environment, that would be a relatively low-risk environment, right? Particularly from an audit or a internal controls over financial reporting, ICFR perspective. So if you have any sort of customization with regards to programming, or if your company has a homegrown software that's integral to what you're doing, that just increases the complexity. Increased complexity means increased risk for auditors, which means more work for you and your team. And it means less hair on your head, probably, to use that metaphor. So my advice is, when you're looking at ITGC environment, you want to try and make sure that you're selecting companies that definitely have SOC 1 Type 2 reports. So for example, we use Bitwave, and we really like the product, and we're really happy with the fact that they came back with a clean opinion on their SOC 1 report. And for those of you that don't know, a SOC 1 Type 2 report is basically an audit by a firm that says that software will do what it says it's going to do. So for example, we have a SOC 1 Type 2 for NetSuite, and the report basically comes back and says, okay, if you get an AP report or general ledger report, you can expect that 1 + 1 = 2, and NetSuite knows that, and they have all these controls around it. However, in the SOC 1 Type 2 report, there's a very important section called Complementary User Entity Controls, CUECs, very technical term. That's what these software providers, including Bitwave, will require you as a company to have in your control environment. So for example, on almost every one of these software packages, it's going to have a CUEC that says that you need to be able to control access or have controls around giving out access to the system. Because NetSuite or Bitwave can't give you accurate information if someone that has access to the system shouldn't have access to the system. That's just one example of a control that you're going to have. So it's kind of like you have to have a control to make sure that the information that the system's spitting out is correct, because you're feeding it with information, if that makes sense. But anyways, the point here is, when you're designing an environment, just steer away from complexity, because it's going to save you a whole lot of time and headache.
Amazing. Let's talk about the team aspect of things. We talked about culture, process. We talked about technology a little bit. How does the team that you have come into play in getting ready?
So I'm a firm believer that the most valuable asset in any company that's not in the balance sheet is your people, right? It's your human capital. And particularly in this space, digital asset space, like, you all here are on the cutting edge of this. And as I tell team members when I'm recruiting them or interviewing, I'm like, you want to get in the digital asset space because this is going to be really the next big thing. And there's not many people with the experience. So get on the train while you can. And it's just important to know, I think right now it's going to be maybe a little hard to find people with digital asset experience, but that's okay. What's important is you find someone with a good work ethic, good experience in accounting and finance, in whatever position you're looking for, and then you make sure that you invest in them, and they go to events like this to make sure that they're aware of what's going on the cutting edge of accounting, finance, and digital assets. Also, importantly, is to make sure that you surround yourself with proper consultants, right? So if you're looking to go IPO, you might not want to hire full-time positions. You might want to, quote unquote, rent it, right? Get certain type of consultants. But you want to make sure you get the right consultants. You want to make sure that they have experience. And that's when you go rent the experience in digital assets, right? If you don't have it on your team, you go ahead and get someone that's familiar with the topic and has done IPO readiness or helped on certain topics for other clients. Bring them on board. I think that you really have to look at that balance of whether you want to rent versus own, if you will, FTE versus contractor, depending on the financing of the company and really the needs. Ultimately, Cleanspark, for example, we have a director of financial reporting and a controller. Controller does the day-to-day reviews, does the debits and credits, keeps Sarbanes-Oxley moving, making sure things are documented well. And then we have a director of financial reporting that does not just the SEC reports, which are done quarterly in the annual Ks, but also doing technical memos, right? But there's a point when, especially right now with where the codification, and where GAAP is at, there's still a lot of questions on a number of items. And so you'll have to lean on those external people. But the point is you're going to have resources in-house to make sure you have the capacity to identify at least, hey, there's an issue here, but then know who your go-to consultants are externally to give you that horsepower and to be able to give you that answer on a short timeline.
One of the parts of your, let's call it external team that you mentioned is your auditor. Does that, obviously they're going to audit you, so they're important, but there are some nuances to picking an auditor, thinking about that. Can you talk a little bit about that?
There's some definite nuances to that. The most obvious of which is you need to make sure that if you're currently being audited, that it's PCAOB registered and that they will actually be able to do a PCAOB audit for inclusion in a registration statement if you're going public. Okay? If not, then you need to talk about moving to another firm sooner than later. And depending on the size of the company and how big you think the IPO is, you might want to go higher pedigreed in terms of a national firm such as a BDO, Grant Thornton, Deloitte, KPMG, something like that. I'll also tell you that, obviously not all audit firms are created equal. You catch me at the coffee break, I'll share some stories. We just recently put out an AK, we changed our auditor. But when you're a $4 billion company, the needs and the expertise is much different than if you're a $200 or $300 million market cap company. So I think my point there is to make sure that one, that they meet the minimum requirements of being PCAOB registered, and two, that they have experience in the industry, digital assets, and ICFR, right? Because you want to make sure that they understand SOX, and they have a number of clients. Like smaller firms that don't do a lot of SOX audits, I think that's going to be a big challenge. And that's been my experience, because you need someone that can partner well with you and understand your control environment and understand how to audit controls, particularly in digital assets, because it's a completely different beast than other industries.
Awesome. I left this topic to last because I think it's one you want to drill into a little bit more, which is reporting. There are specific reporting things that you can expect. Talk about that a little bit here.
So when you're a public company, there's additional items you don't have in a private company audit, such as considerations around segment reporting, MD&A, which is management discussion and analysis, and non-GAAP measures. And I want to give you some real world stories here. And fortunately or unfortunately, for those of us that are already public and gone through the process, and is very well known, the SEC has not been friendly to digital assets, right? And that's why this election coming up is going to be very important, because it is now a topic, right? Digital assets now is part of the GOP platform, which is amazing. I mean, this is a real election topic. And now I hear Kamala might be in town for the Bitcoin conference this week to speak on the other side of Trump, not at the same time, but she'll be speaking even though Trump is there. But anyways, the point is that public companies either that have gone either de-SPAC or IPO or are already public have been interacting with SEC for some time. And full public disclosure, we're in a comment letter process still. 18 months it's going on, which is a long time comment letter process. And this is all disclosed in our Form 10K. But you can expect that that the SEC, in their words, continues to get smarter about certain things, which I would kind of question, because I think that sometimes their comments and positions on things aren't really necessarily in the best interest of investors. If anything, they cause confusion. And one item I want to talk about is non-GAAP measures, okay? And non-GAAP measure that you see often in many industries is EBITDA or adjusted EBITDA, right? Because it's very indicative of what the underlying cash flows are of the business. And if you have adjusted EBITDA, typically you're adjusting out either one-time items because of large transactions or lawsuits, or sometimes there's a non-cash item that is in EBITDA, but you adjust it out because it's just non-cash, doesn't relate to your operations. And the example I want to talk about is MicroStrategy. If you don't know about MicroStrategy, Michael Saylor is kind of like Bitcoin Jesus, right? He's on YouTube, talks about Bitcoin a lot. He's a very intelligent man, and he's grown MicroStrategy from a couple $100 million to like over $20 billion market cap now, primarily because he's issued equity to just buy and hold Bitcoin, and now they're getting a software development on Bitcoin layer 2. But a couple years ago, they got an SEC comment letter saying, and this is during the period of time when digital assets were under the old rules about impairment. And the comment said, hey, you can't take out your impairment on Bitcoin anymore. Mm-hmm. And they went back and forth, and ultimately they had to concede the SEC wasn't going to move off that. But the SEC's point was, this is essential to your underlying operations, so you cannot remove the impairment out, which is punitive, right? Because if you're adding back to your adjusted EBITDA an impairment on digital assets, you're increasing your EBITDA, right? But that makes a whole lot of sense in a lot of businesses, particularly if you're just holding it as a treasury or an investment mechanism, and you're doing another business like mining, for example. It has nothing to do with mining. We just have another asset that we expect to appreciate on our balance sheet. And recently we had the obviously change to fair value, where you have mark to market, where I personally still think that should be adjusted out, but the SEC has taken the position that unrealized gains and losses on your income statements need to stay in it. So now if you hold Bitcoin, for which we hold almost 7,000 Bitcoin, right, which is almost $500 million of Bitcoin, and given the volatility of Bitcoin, if it swings from one quarter to the next, I got to mark to market that. I could have a large gain one period and a large unrealized loss in another period, but I can't take it out of EBITDA. And so investors inherently, and the analysts even do this, they take it out of their calculations to figure out really what the true underlying operations are. So I tell you this because, much like GAAP, it doesn't always make sense, right? The SEC is going to come back with comments in your S1 process or registration statement process, or even when you're public and you get that comment letter on your filings. It may not make sense, but as long as you have good consultants around you, and you have a good team, and you've maybe looked at some of the other filings from other public companies to kind of anticipate what's going on, you'll be in a better position. But that's just an example of some of the type of stuff you can expect just either going through the IPO process or just being public.
Awesome. So Gary, with say 10 seconds left, we talked about a lot of things. Talked about culture, process, controls, technology, advisors. Is there a summary parting word statement, something that you'd say to a CFO that has an IPO in their future? A summary thing that you would say.
Are you sure you really want to do this?
Okay, that's a
no.
good one.
It's very rewarding. Obviously, it's very exciting to be part of an IPO. I think that I remember being a staff as an auditor, being like, wow, look at all the money these guys make. Like anything else in the market, it's risk reward, right? It's a lot of work, but it can be extremely rewarding. So I think particularly for the CFOs, I would say make sure you understand that when you sign on those financial statements, that you are putting your house, your personal liability, your personal finances on the line. So you want to make sure that every number on there better be darn right. So that means that you want to have the culture, the process, the systems, and ultimately the people that you trust, and your way, and the way that your consultants and advisors advise you on, because ultimately, at the end of the day, it's your accountability.
Amazing. Thank you very much, Gary, and thank you guys for listening.